Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was suggested by a subscriber. That stock is called DR Horton. We will be reviewing the company's 10K annual report to look at the company's business profile, review the 4 operating segments, then we'll look at the company's key ratios, perform a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if you were to invest in the security at the current stock price, what kind of return can we expect on this investment? So let's dive in and review DR Horton Incorporated. Hey guys, let's start off by looking at the Form 10K, which is the annual report that DR Horton filed with the SEC for the fiscal year that ended December 30th, 2020. Over here, we'll start off by getting a better idea about the business. DR Horton is the largest home building company in the United States as measured by number of homes closed. It constructs and sells homes through its operating divisions in 88 markets across 29 states, primarily under the names DR Horton, America's Builder, Emerald Homes, Express Homes, and Freedom Homes. The company then talks about its 4 operating segments, the first one being home building, second, the majority-owned residential lot development company, third is financial services, and the last one is other activities. Its home building operations is its core business, generating about 97% of its consolidated revenue of $20.3 billion in year 2020. It states that 91% of its home sales revenue in fiscal year 2020 was generated from the sale of single-family detached homes. The company also claims that it is the most geographically diverse and largest volume home builder in the United States. The company also outlines how back in 2018 it acquired 75% of the outstanding shares of 4-Star Group Inc. 4-Star is a component of DR Horton's homebuilding strategy to enhance operational and capital efficiency and returns by expanding relationships. The report then talks about its third operating segment, which was the financial services segment, where it says that its financial services operations provide mortgage financing and title agency services to homebuyers. And lastly, the company talks about its other businesses and subsidiaries such as insurance-related operations, construction and own income-producing multifamily rental properties, own non-residential real estate including ranch land, and improvement and own and operate oil and gas-related assets. Now that we have a better idea of these 4 operating segments, let's look at its revenue breakdown. Over here, we can see the revenue breakdown across each operating segment, that is home building, 4-Star, financial services, and others. Home building, home sales brought in about $19.56 out of the $20.311 billion in 2020. Since home building, home sales is such an important component of DR Horton's revenue, let's learn more about the home building section. On this page of the annual report, the company goes into detail about its home building inventories by reporting segments. We can see that in 2020, the majority of inventory is in Southeast, Southwest, and Western regions. Next, looking at the home building results by operating segments, we can see that when we compare the 2019 to 2020 revenue, there is an increase in sales across all these geographic regions. Now that we have a better understanding of DR Horton's business profile and its 4 operating segments, let's dive deeper into the company's fundamentals by reviewing its key ratios. Hey guys, now let's look at the key ratios. I'm on Morningstar looking at DR Horton Inc. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company makes from its sales. Back in 2011, DR Horton Company made about $3.6 billion in sales, and for the year 2020, it was about $20.3 billion. We can see that every year for the past 10 years, DR Horton Company's sales have increased. Next is the operating income. The operating income is the amount of money that's left with the company once it has paid for the cost of goods and the operational expenses. Back in 2011, DR Horton's operating income was $54 million, and for the year 2020, it was $2.8 billion. Looking at the trend for the operating income, we can see that the operating income has been increasing every year for the past 10 years. Next is the net income. The net income is the amount of money that's left with the company once it has paid for the cost of goods, operational expenses, non-operational expenses, interest on its debt obligations, and taxes. Back in 2011, DR Horton's net income was about $71 million, and for the year 2020, it was about $2.4 billion. The 10-year trend for the net income has been increasing every year for the past 10 years, except in 2012 when we saw a big jump up in the net income when it got to about $956 million. And then in 2013, it dropped back off to $462 million. This big jump up in 2012 could have been caused because of a one-time sale that the company made, causing it to inflate its net income. Next, looking at the annual dividend payout per share. Back in 2011, DR Horton paid about 15 cents per share as dividend, and for the year 2020, it paid about 70 cents per share as dividend. Every year for the past 10 years, DR Horton has been paying out dividends. There has been a 1 year back in 2013 when the company did cut its dividend, but ever since then, it has been hiking its dividends. As shareholders, we want to invest in companies that have predictable and stable dividends, and it's even better if the company is hiking its dividends, and that has been the case with D.R. Horton Company since 2013. Next, looking at the shares outstanding. Back in 2011, the company had 319 million shares outstanding, and for the trailing 12 months, it has 369 million shares outstanding. We can see that the shares outstanding reached its peak back in 2018 when it got to about 383 million shares, and after that, the company appears to have been buying back its shares as the share count has now dropped off. However, when we look at the past 10-year window, we can see that the share count has clearly increased from 319 to 369 million shares. As shareholders, we want to be invested in companies that are buying back its shares, as this process of buybacks increases the existing shareholders' ownership within the company. After that, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, the company had $8.29 per share as its book value, and for the trailing 12 months, that number has grown to $34.33 per share. It's good to see that over the past 10 years, the company's book value has been positive and increasing. And finally, looking at the free cash flow. The free cash flow is what we get when we subtract the capital spending from the company's operating cash flow. Back in 2011, the company's free cash flow was negative, and for the year 2020, it was about $1.3 billion. When we look at the past 10-year trend, we can see that from 2011 through 2014, the company's free cash flow was negative, and ever since then, the company has had positive free cash flow. It's interesting to note that from 2012 through 2014, the company had positive net income, yet its operating cash flow turned out to be negative. This could be because in those years, the company was buying a lot of inventory, which in D.R. Horton's case would be homes, which causes cash to leave the business, making the operating cash flow to be negative. I will be using the past 10 years of free cash flow for my expected rate of return calculation, and I will be using the 2020 figure of $1.325 billion for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company. We'll start off by talking about the net margin. The net margin compares the company's bottom line to its top line, so it compares the net income to the revenue. Back in 2011, the company's net margin was 1.97%, and for the year 2020, it was 11.69%. What this means is every $100 that the company made in 2020, by the time it paid for the cost of goods, operational expenses, non-operational expenses, interest on its debt obligations, taxes, it had $11.69 left as pure profit. It's good to see that the company's net margin every year for the past 10 years has been positive. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2011, D.R. Horton's return on equity was 2.74%, and for the year 2020, it was 21.72%. The company's return on equity has been greater than 8% every year for the past 10 years except in 2011. Next is the return on invested capital. This number gives us an idea of how good the management is at investing the capital and getting a return on that investment. Back in 2011, the company's return on invested capital was 2.18%, and for the year 2020, it was 16.05%. Finally, looking at the interest coverage. The interest coverage compares the company's income to its interest obligations, so it gives us an idea of how many times can the company pay off its interest obligations in a calendar year. Benjamin Graham preferred to only invest in securities that had an interest coverage of 5 times or greater. Back in 2011, the company's interest coverage was 1.23 times. For the year 2013, it was 129.98 times. If we look at the company's notes to its financial statements, we'll get an idea why the company does not have any meaningful interest coverage to report after 2014. Over here, the company states that we capitalize interest costs incurred to inventory during active development and construction. Capitalized interest is charged to cost of sales as the related inventory is delivered to buyers. So what this means is the interest obligations that the company has are pushed to the balance sheet. In other words, they're capitalized. And eventually, when the company sells the home or the inventory, those costs are brought back to the income statement and expensed at that time. Okay, now let's look at the financial health of the company, starting off by talking about the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to invest in companies that have a current ratio of 1.5 or higher. Back in 2011, the company's current ratio was a 4.62, and for the latest quarter, it's about 9.13. A high current ratio is not uncommon for homebuilders because inventory or homes make up a big component of the current assets. However, when we look at the current ratio, which is the company's current assets minus its inventory divided by the current liabilities, we get an idea of how liquid the company is by disregarding the inventory component. Ideally, we want to see the company's quick ratio to be greater than 1.0. Back in 2011, the quick ratio was at 1.06, and for the latest quarter, it's at 1.40. So a ratio greater than 1 indicates that even if the company is unable to sell its inventory, it still has other current assets to fulfill its current liabilities. Next, looking at the financial leverage. The financial leverage compares the company's total assets to its shareholders' equity. Back in 2011, the company's financial leverage was at 2.04, and for the latest quarter, it's at 1.58. We can see that over the past 10 years, the company's financial leverage has steadily been on a decline. Finally, looking at the debt to equity ratio. This ratio compares the company's total debt to its shareholders' equity. Ideally, we want to see this number to be less than 1. Back in 2011, the company's debt to equity ratio was at 0.65, and for the latest quarter, it's at 0.34. Similar to the financial leverage, the company's debt to equity ratio over the past 10 years has steadily been on a decline. D.R. Horton's financial leverage and the debt to equity ratio is fairly comparable to its competitors such as Lennar. Finally, let's look at the efficiency ratios. Starting off with the days inventory. This number gives an idea of how many days does D.R. Horton's homes sit in its inventory before they're sold. Back in 2011, the days inventory was at 416 days, and for the year 2020, it's about 279 days. Over the past 10 years, the company's days inventory have been declining, which is a good sign. We do not want a company to just have its inventory sit around. We want a company to get rid of its inventory as soon as possible. That way, that inventory can be moved from the balance sheet to the income statement, revenue can be recognized, and eventually a profit can be seen. Next is the payables period. The payables period gives us an idea of how many days does D.R. Horton take to pay its suppliers. Back in 2011, the company took 20.57 days to pay its suppliers, and for the year 2020, it was about 18.22 days. Over the past 10 years, we can see that the payables period have stayed fairly consistent. Finally, looking at the inventory turnover, this number gives us an idea of how many times does D.R. Horton's inventory go through its system in a calendar year. Back in 2011, the company went through its inventory about 0.88 times in a year, and for the year 2020, it was at 1.31 times. The 10-year trend for the inventory turnover has been increasing, which is a good sign as it means that the company is going through more inventory. Now let's compare the company's current valuation to that of the S&P 500. The first item on the list is the price to earnings ratio. D.R. Horton's PE ratio is at 10.8, whereas S&P 500 is at 27.4. Next is the price to book. D.R. Horton's price to book is at 2.3, whereas S&P 500 is at 4.0. After that, price to sales. D.R. Horton's price to sales is at 1.3, whereas S&P 500 is at 2.8. After that, price to cash flow. D.R. Horton is at 23, whereas S&P 500 is at 16.3. And finally, the dividend yield. D.R. Horton's dividend yield is at 0.9%, whereas S&P 500 is at 1.7%. When we look at the price to earnings, price to book, and price to cash flow, the company appears to be undervalued to the S&P 500. However, when we focus on the price to cash flow and the dividend yield, D.R. Horton is overvalued when compared to the S&P 500. Hey guys, now let's look at the discounted free cash flow DCF analysis for D.R. Horton. Over here, I pasted the 2020 free cash flow number that I got from Morningstar, which was $1,325 million. The annual growth rate of free cash flow is 5%. What this means is I expect D.R. Horton's free cash flow to grow at 5% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I expect this investment to give me a 10% return. The long-term growth rate is 3%. What this means is I expect D.R. Horton's free cash flow to grow at 3% every year from the 10-year mark into perpetuity. The company has 369 million shares outstanding, and the long-term debt is $4,283 million. I got this number from D.R. Horton's balance sheet. After taking all of these inputs into account, we get the intrinsic value to be about $48 per share. When we compare this intrinsic value to the current stock price of about $80 per share, we can see that the current stock is trading about 66% above its intrinsic value. The way we calculated this intrinsic value is we looked at what the free cash flows would be every year for the next 10 years. We summed up all those free cash flows, which came out to about $10.3 billion. Then we looked at what the free cash flows would be from the 10-year mark into perpetuity. We summed up all those free cash flows to get the intrinsic value to be about $22 billion. Then we subtracted the long-term debt from this number, and divided by the shares outstanding to get the intrinsic value per share to be about $48. If we disregarded the perpetuity component, in other words, if we think that D.R. Horton's free cash flow will only grow for the next 10 years and then the growth will just stop, then we can get the intrinsic value without the perpetuity component to be about $16 per share. And if we disregarded the perpetuity and the debt, then we get the intrinsic value without the debt and the perpetuity to be about $28 per share. Hey guys, now let's look at the expected rate of return calculation for D.R. Horton. Over here I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get over the years. We can see that ever since 2016, the free cash flows have been positive and mostly increasing. Looking at the future data and predictions, I'm assuming that there's a 40% likelihood that D.R. Horton's free cash flow will grow at 8%. There's a 50% likelihood that its free cash flow will grow at 3%, and a 10% likelihood that its free cash flow will decline at 10%. These are the potential free cash flow rates that we get into the future. When we take into account the numbers of shares outstanding, which is 369 million shares, at the current stock price of about $80.02 per share, we can expect to get a return of about 3.3% if we were to hold this security through 2045. What this means is, if we were to purchase a share of D.R. Horton at the current stock price of about $80 per share, we can expect to get a return of about 3.3%. Hey guys, now let's wrap it all up. We saw that D.R. Horton's revenue, operating income, as well as net income have been increasing. The company has been hiking its dividends every year since 2013. The return on equity has been greater than 10% every year since 2012. The company's free cash flow has been positive and growing for the past few years. When we looked at D.R. Horton's current and quick ratios, we saw that the company has more than enough current assets to fulfill its current liabilities. After that, we looked at the company's financial leverage and debt to equity ratio, which pointed out that the company does not have a lot of debt or liabilities on its balance sheet. This is a good sign because during turbulent times, the company is less likely to go under because it does not have a lot of debt. Next, we looked at the efficiency ratios, which showed that the company has gone better at selling its inventory. After that, we compared the company's current valuation to that of the S&P 500, and on 3 of the 5 valuation metrics, D.R. Horton was undervalued to the S&P 500. Next, we performed the discounted free cash flow DCF analysis, where we found out that the intrinsic value of this company comes out to about $48 per share. And when we compared that to the current stock price of about $80 per share, we can see that the current stock is trading at about 66% above the intrinsic value. After that, we performed the expected rate of return calculation and found out that if we were to invest in the security at the current stock price of about $80 per share and hold it through 2045, we can expect to get a return of about 3.3% on this investment. Lastly, it's important to note that its current chairman, Donald R. Horton, owns about 6.6% of the common stock, and the company's officers and directors own about 7% of its common stock. As shareholders, we want to invest in companies where the management has a vested interest in the company. In other words, when the management has skin in the game, we know that the management interests are going to align with those of the shareholders. Additionally, the management is not only going to look at the near-term performance, but is also going to make sure that in the long term, the company outperforms and does better than its competitors. We can see that the current stock price is trading above its intrinsic value. However, for such a strong fundamental company, it's not uncommon for the stock to be trading at a premium. Superior North is definitely going to have this stock on its radar. Hey guys, that is all I had for you this week. Hopefully you found this video on D.R. Horton interesting. If you do like this content, please do like, share, comment, and subscribe to my channel. And if you have any suggestions as to which stock I should review next, please leave it in the comments section below. I will greatly appreciate it. Thank you.